So, Casey, what are we doing here today?
Recording a webinar. There's been a lot of crazy. It's the first time I put on a suit in 2 months, so I was glad that the suit fit. Feeling good. We're at Crown Haven headquarters here in Carmel, Indiana. We've been rebranding, as folks will see. We've got our new logo, we've got our new colors. It feels pretty good. But I'm going to be doing a webinar today. A lot of turbulence in the global markets, a lot of things going on. So, obviously with the fear of coming out and doing traditional workshops, as a certified educator with the Society of Financial Awareness, we do bi-monthly workshops typically for Crown Haven. I thought it'd be good to come into the office and do a webinar for anybody that wants to watch it, and we're just going to put it on demand online. So anybody who's thinking about retirement, wants information, what they should be doing right now, just has general questions, we're going to be putting together a webinar for them today. So feels good to be back in the office, seeing you guys, and hopefully the information that we put together will be valuable for everybody that sees it. So looking forward to getting this done, and I look forward to any of the comments or questions that people have regarding the information that we're going to be putting out. And as always, you can reach us at crownhaven.com.
You know I struggle to find the words to make it all seem clear to you. You know it's hard sometimes not to step out of bounds. Drag me out of here. Speak up and tell me how I sin. I don't mean anyone harm by loving you. So it comes as a surprise. My only goal is just to make you smile. I wanna make you fall in love with me. Take you right out of this town. Show you life beyond that picket fence. Dream just as big as you want, darling. Ain't no one says we can't.
Well, hello to everybody who's watching. My name is Casey Marks. I'm the founder and president of Crown Haven Wealth Advisors. We are a local independent and fiduciary practice located right here in Carmel, Indiana. Today we're going to be doing something a little different. I'm going to be doing a webinar of our Retire Shield presentation, which as a certified educator of the Society of Financial Awareness, I provide bi-monthly workshops to the local Indiana community. And we'll do these at universities, we'll do them at libraries, community centers. And the purpose really is to show folks some common misconceptions about retirement planning, look for opportunities that they might be able to explore, expose some threats that exist. And so we've had some great success with this Retire Shield workshop just in informing the public. And with COVID-19 being the way it is, and with our demographic being what it is, we're trying to be acting with an abundance of caution and ensuring, though, that during these stay-at-home orders and as we kind of slowly come back into business as usual, that folks are still able to receive the same great information that we were providing on a bi-monthly basis to you whenever you'd like to consume the information. So with that being said, today we are live and we are providing this to literally hundreds of viewers right now are looking in on this, but this will be on demand. So you just click the link and you'll be able to watch it as many times as you'd like to watch it. And as always, you can reach us at crownhaven.com. You can request your very own Retire Shield process, which is, I'll go into that a little bit later. But without further ado, I'm going to go ahead and start here. So we're Crown Haven Wealth Advisors, and I'm going to give you a little bit of a background on me. So my name's Casey Marks. I'm the founder and president, like I said. I've been a nationally recognized top advisor since 2015. Our office in Carmel, Indiana, is consistently one of the top producing offices in the country. We have hundreds and hundreds of clients that join our firm on an annualized basis. And the reason for that is, like any other local business where the owner works within the business, we care a great deal about our clientele. We're not a corporate-owned entity where we have sales quotas, et cetera, et cetera. I'm a registered member of the National Ethics Association, so if you want to check that out, you can go to NEA.com. Like I said, certified educator with the Society of Financial Awareness. I'm the founder of Smart Money Radio. I've been doing a radio show on WIBC and Freedom 95 for the past 7 years here in the state of Indiana. One of the top rated radio shows in the state. I'm also an author. I've written 2 books. One is called Smart Money. The other is called Baby Boomer Retirement Boot Camp, of which, if you'd like a copy of our book, go to our website. There's a form to fill out. You can get Baby Boomer Retirement Boot Camp for free. I attended Central Washington University in the state of Washington, went there for business. My personal story is that my father passed away when I was 15. The reason I got into this industry, my mom lost almost everything she had working with an advisor, so that's why I got interested in this field. The reason that I went to Central was because I had no money to pay for a university right out of high school, so I actually went to community college, then I went to Central Washington, and then I went to subsequent colleges for graduate programs and things of that nature. Also went to the American College of Financial Services. I am a RICP, that's a Retirement Income Certified Professional. If you're familiar with the CFP is Certified Financial Planner. Retirement Income Certified Professional just has a very intense focus on the retirement income planning portion of retirement, ensuring that no matter what happens, you're going to be okay throughout your golden years. I've been named one of America's financial leaders by Forbes magazine. I've also been quoted in Yahoo Finance, CNBC, Acorns, Wall Street Journal, et cetera, et cetera. So we've had quite a bit of media presence as well. Some great notoriety with several major media companies as well. So that's me. So the question that I ask when we do these live, and I'm going to ask folks to be typing in their questions to me as we do this live for you on the web, is what do you want out of retirement? And the reason that I ask this question is because, look, I've got clients in 17 states. We service over 700 families just in the state of Indiana. And regardless of the differences that we as a people have, whether it be where we get our start in life, maybe our political persuasion, even gender, we all basically want the same thing. We want to be happy when we get to retirement. But your version of happiness is different than my version of happiness maybe. Your version of happiness could be you want to be able to travel the United States in a motorhome, or you want to visit your grandchildren, or maybe you've never been out of the country and you want to go visit Europe, or maybe it's just you want to know that you're okay. Whatever your needs are, we need to define that, because until we define what it is that we want, we don't have, it's like having a treasure map with no guide. So we want to make sure that we understand what we want out of retirement. So I'm going to ask everybody watching that instead of just playing along in your head, you write down what you would like to have happen in retirement. And you can comment below as well. What do you want in retirement? And the reason I ask that, of course, is because once you know what you want, once you know the desired outcome, then, only then can we plan for it. And so the next question, and I'm looking at a few of these here, what do you want out of retirement? And Gary in Carmel is saying He wants to know that he's going to be okay regardless of what happens with the market. So basically, Gary is saying that he wants to make sure that his income is going to be secure. And I'm going to talk a little bit about pensions and secure income sources in a little bit. But for Gary, it sounds like he just wants to be okay. The question then becomes why? Why do you, and for Gary, it sounds like he wants to be all right. But if I asked you what you want, then the next logical question is why do you want it? And I think it's important that we write down our whys as well. Why does this matter to us? Because a lot of times working with clients, what I see happen is retirement planning is very above the shoulders. It's very acidic. It's charts and graphs. And a lot of planners, a lot of advisors lose the true meaning of what they're doing. And a lot of clients do that as well. They get caught up in the numbers and the figures. And our goal at Crown Haven is connecting the what you want and why you want it back to those numbers so that the net outcome from whatever those numbers are gets you what you want to have happen, if that makes sense. So when it comes to your why, it's very important to understand why you want what you want, and then all that's necessary after that is putting the proper tools in place. So the next question we ask is, how would it make you feel to accomplish that? So if your goal is, what you want is you want to be financially secure in retirement, and why is because you want to be able to ensure that, I had a client the other day that said he wanted to make sure that his grandchildren would be able to go to college. That's his why. He wants to leave legacy. Well, why is that important to you? It would make me feel good. I can leave a legacy. I felt like I've done something, right? That's important to him. Well, how would it make you feel to accomplish that? I asked him. He said it'd make me feel phenomenal to accomplish that. So it's important to connect the what, the why, and then obviously we got to figure out how we're going to do that, right? So I'd like everybody to comment their whys as well. And this might be a little different than other advisors you've heard talk, or we're going to get into some numbers and things like that. But at Crown Haven, it is incredibly important to us to understand our clients as people. Because at the end of the day, you are people. You are a person. You have wants, you have needs, you have desires. It is not enough to look at you as a number or as your money as numbers. We need to understand who you are so we can help you get what you want and what you need. So, what is your why? Write that down and comment below. So then the question I ask folks, and before we get any further, I don't want you to let any negativity come into your brain yet. Let's just work with this thought process. What if it was solved? How would you feel if it were solved? Not a worry. Not a worry at all. So whatever your what is, whatever your why is, imagine that, let's time warp into the future. It has been taken care of, it's solved, and not only has it been solved, but you've seen it through, because retirement is a race that you only know if you've won when you get to the end. So let's imagine we've gotten to the end and it's worked. How would that make you feel? And for a second, I just want you to think about that. How would it make you feel? Of course, it'd make you feel phenomenal, right? You'd feel great. So this is the feeling that we are working towards at Crown Haven. This is what we're trying to give you the feeling of immediately. And that can only come with really great planning. And this is why our firm, over the course of a decade, has consistently grown and grown and grown, because we are showing real life results to people very quickly. As an aside, and this is an aside from the workshop, the webinar here, but during the COVID crisis, when the economy was falling on its face, when people were losing money, the market drops 34%, the Standard & Poor's 500 drops 34%. Right now, it's still down 9% for the year. Our clients, meanwhile, we have been locking in gains. Our clients are net up about 5.5% right now for the year. So the power of really good planning cannot be underestimated, okay? But, so I've got a question. Now that we're in this, your retirement's secured, it's solved, it's not a worry, now let's let that negativity come in. So what are the issues? What are the roadblocks? Why do we feel like it's not solved? Okay? What things are preventing you from that reality? And let's look at, excuse me for a second, I'm going to look down at my iPad here. I'm looking at some examples that folks are writing in. Cindy in Greenwood is saying uncertainty surrounding the market. Okay, uncertainty surrounding the market. Okay, we've just witnessed this. March 23rd, we had some significant lows. Fees, I've got fees here. We're going to talk about fees. We're also going to talk about uncertainty in the market. Uncertain income. David out in Greencastle. I haven't saved enough. Somebody from Plainfield just said that. Taxes. Okay, so we've got lots of examples of things that people are worried about. They're saying, you know, this is preventing me from this reality. Okay, so we're going to talk about all of those things during this webinar, and I would encourage you to watch this all the way through because it's going to be very valuable for you. And again, this is a free webinar we're providing, a certified educator with the Society of Financial Awareness. I want you guys to learn. But first, I want to congratulate you for even sitting here and watching this in the first place. There's a great quote from somebody that I highly respect, and I've been fortunate in my life to be surrounded by some very successful people. I started with nothing. Like I said, put myself through school. Knowledge for me was the result of necessity. I needed to make sure that my mom would be okay after my dad passed away. And one of the billionaires that I've met that shared a little wisdom with me said, breakthrough moments and great ideas don't come to you, they are sought out. So the hot stock tip is not going to get dropped on your lap from the guy shining your shoes. You have to seek out good information, and then that will open up your mind, and then you can do with that information what you want to do with it. But I commend you for even being here in the first place. All of those issues that were just mentioned need to be dealt with. I want to commend you all for pursuing answers to those issues. So before we go through the issues, though, I want to talk about why we're in the position we're in the first place. Because the reason I got into this industry was because I believe that it's a fundamentally flawed sales system. And so let's talk about that. Let's talk about the elephant in the room, okay? Who remembers pensions? And normally I'd ask folks to raise their hand, and who remembers pensions? Let's see if anybody gives me a thumbs up or anything online here. Yeah, I've got some thumbs up. So some people remember pensions. Now, luckily, in the state of Indiana, we've got folks that work for school districts, work for hospital systems. So those folks are lucky. They've got some semblance of a pension. But for most of us, we don't have pensions. It used to be that everybody had pensions. But the question I have for the audience here is, you'd work for years and years, and you'd get what? And I'm going to give you a second to type those answers out to me. I've got Michael in Fishers saying a pension. Okay, yep, a pension. But the answer is secure income, okay? You would get secure income. So let's talk for a second about how valuable secure income is for a second. So in the past, in this scenario, you're employed, and to the extent of which your employment is secure, and unfortunately with COVID, we're seeing unemployment rates going up. And hopefully that stops. Hopefully we can get back to normal soon. But to the extent of which you have secure employment, you have secure income. You can base your entire life off of that, right? You can say, you know, I make $4,000 a month or $6,000 a month or $10,000 a month if you're lucky, but I can take my children out to dinner. I can plan a vacation. I can save this much of my income. I can build my life around this amount of income. In the past, when you retired, you would work a certain amount of years of service that would qualify you for this, but then you retire and you get a pension, a defined benefit from your employer. And it was your employer's responsibility to ensure that that defined benefit was there for you, and then you would get income. Now it'd be a percentage, maybe 60% or 70%, but you knew it was going to be there. When you retire, you have secure income and you can plan your lifestyle around having enough money. That person that had the pension back in the day didn't need $1 million or $2 million or $5 million or $10 million saved to try to figure out how much percentage of their money they should be taking as income or interest. They didn't have to worry about that because when they retired, they just knew they were going to have enough money to sustain them, okay? And it wasn't going to run out. That's the other thing. But let's look at present day. So present day, most of us, we're employed, we've got income, we can rely on that income to the extent of which our employment is secure. But now we've got these investment things. We've got 401ks, we've got 403bs, we have 401as, maybe deferred compensation, non-qualified plans. We've got SEP IRAs, we've got simple IRAs, we've got our own IRAs, individual IRAs, maybe a Roth IRA, maybe a brokerage account. The point is, it used to be point A, then point B, you retire, and you've got secure income. Now it's point A, you're working. Point B, you don't know what the heck's going to happen because it's all market-based. Point C, you retire. Maybe you've got enough money. And 401ks, when they were brought about and invented, they were meant to be a complement to Social Security, by the way. They were not meant to be the replacement for the pension. But what happened was payroll executives determined that they could save on average about 70% over the course of an employee's life cycle if they put the onus on you. So instead of having to save a bunch of money and manage that money so that they could pay you out for the rest of your life, now they're just putting the onus on you. Hey, you save, and we'll match you 5% or whatever, but now it's not their responsibility anymore. And that, by the way, created an entire cottage industry. Because if you have, and it's a multi-trillion-dollar industry, but if you have your 401k with broker-dealer X, and then you retire, what are you most likely to do? Keep it with broker-dealer X. And they're going to keep charging you the fees, and your money's still going to be at risk, et cetera, et cetera. But the main point from the two slides I've just shown you is all of a sudden now you've got a guessing game going on. So you're looking at this going, you know, do I have enough? How do I use my money to live? What kind of lifestyle can I afford? How will I make sure my spouse is okay if I pass away? Now, the question I ask my clients a lot is, all of us would love to have $1 million saved, right? But if I gave you the choice between having $1 million right now, and some of you might have $1 million, but let's use whatever number it is. For the folks who make $100,000 a year, maybe it's $5 million, whatever, a huge amount of money. If I gave you a huge amount of money, but you don't know whether or not it will last you for the rest of your life and the life of your spouse, or I guaranteed you that you would have enough monthly income to satisfy you for the rest of your life and the life of your spouse, and you'd also be able to leave a legacy, which of those two would you choose? Most people, hands down, would choose knowing that I'm guaranteed to be okay. And also, I can still leave my legacy, right? But you don't need $1 million or $5 million to do that, and that's the thing. So we're going to talk about that in a little bit. But without pensions, now we're left with two legs out of what used to be a three-legged stool. So now you got your 401k, which for those keeping track was supposed to be a supplement to Social Security and not a replacement for a pension. But now pensions are basically gone. Now you got a 401k and Social Security, which, who thinks Social Security is going to change over the next 10, 15, 20 years with the amount of debt that we have in our country? They're already saying they're going to change it by 2030. So if you're like most of our clients at Crown Haven, the 700 plus families we've got, you've chosen to work with an advisor already, probably, because you realize that this is a problem and you want to figure out how to make it when you retire. Or if you're already retired, you're trying to figure out how to make it right now. But the problem is not all advisors are equal. So who are advisors? And this is what I was going to get to a few minutes ago when I said the financial system is fundamentally flawed and it's a sales system. And this is the reason that I got into this business in the first place, because it failed my mother. This financial system is built to sell you stuff, and most people who work within it have no obligation to act in your best interests. They're captive, which means they can only work with products and services that their company approves, and they're operating under what's called the suitability standard, which basically means that they just have to prove to regulators that whatever they sell you on a particular day is suitable, not that it's in your best interests. And they're singularly focused on returns and nothing else. There's a lot more to retirement than just returns. So normally, the advisor is a salesperson, not an advisor. Their ability to remain at the firm is directly correlated to their ability to sell stuff. They're a production outfit, okay? Which means they cannot truly act in an advisory capacity. Because what if the advisory capacity goes against them selling stuff, which puts food on the table for their family? And then if you add on top of that, they're captive, so they've got this narrow window of what they can provide. Imagine being in that position. I mean, I'm not trying to rail on anybody here. I'm just giving you the facts. Imagine you work at an advisory firm that's captive. You need to make money for your family because you're trying to build your own retirement, and you're trying to make sure your wife is okay, or your husband is okay, or your children are okay. And you've got a very limited toolbox to offer your clients, but you still need to make money. Are you an advisor at that point, or are you a salesperson? There's a very difficult moral quandary that person has to work within. And I do not envy those people. That's a very difficult job to be in. But they're salespeople, they're not advisors, they're captive, and they're not independent. If you're independent, like Crown Haven is, we have access to the entire spectrum of what's available. So wherever you're sitting right now, if you were to look at a wall, a blank wall, and you imagine that to be the entire universe of investment products, insurance products, etc., anything that a retail person can get access to, an independent advisor can choose all of those different items. Or if you looked at a toolbox that was just full, they can use all of the tools. If you're captive, you might be only able to offer one of the tools or three of the tools instead of all of the tools. And furthermore, because they're not truly advisors, they're salespeople, they're operating under the suitability standard, which again, they just have to prove that what they're offering you is suitable in that moment. So an example of this could be, if anybody's been paying attention to the oil market, somebody comes into the office February and they say, Casey, I really like oil. If I'm operating under the suitability standard, I say, okay, great, we're going to put all your money in oil. That is a suitable recommendation at that point in time because oil's doing okay. Well, oil drops by 80% in March. Am I holding the bag? No, I'm not holding the bag because it was suitable when I sold it. So if I'm a suitability type advisor, you just lost 80% and I can go like this. And that's not what you want. Okay? Fiduciary is what Crown Haven is. Fiduciary is legally obligated to act in the best interests of the clients. And the way we look at it is all of our clients, all they're trying to do is leverage our knowledge, right? So the way I look at it is if I were you, in your particular situation, all clients are in different situations. They've got certain amounts of debt, they've got certain amounts of assets, they're at a certain timeline to retire, maybe they're already retired, they have different income needs, they have different legacy desires, different tax situations. It's all different. Everybody wants to be happy, but it's all different. My job is to step into your shoes and use my brain so that I can provide you the best possible result given your circumstances. That's my job. The ideal advisory scenario is you can basically take control of all the knowledge that I have up here and act in your best interests. So it's a collaborative relationship. And that's how an advisory relationship should work. That is not how the industry works 95% of the time. Okay? Furthermore, most advisors are focused on Returns. If you're out on the golf course with your friends, they're talking about the returns they got. Have you ever noticed, by the way, that nobody talks about the negative returns? Nobody ever says, man, I lost 30% yesterday, and they make a joke about it. They don't talk about that. They only talk about their winners. But winners are usually not 100% of the portfolio, probably 10% of the portfolio. So maybe I'm up 30% for 10% of my money, and the other 90% is down. But we are so focused on return. For retirement advising, and this comes from my RICP training, Retirement Income Certified Professional, you need a holistic focus. You need someone who understands income generation, risk management, tax ramifications, legacy planning, long-term health care planning, etc., etc. There's all these different things. Every decision in life has a ripple effect. Okay? So basically, most of the system is geared towards somebody who's a salesperson, not an advisor, somebody who's captive, who's not independent, somebody who doesn't have to act in your best interest, and somebody who's only focused on returns. So if you're working with an advisor already trying to get this figured out, chances are, and this is just the fact, chances are you are working with somebody like this. And that is why Crown Haven is consistently doubling every year, bringing new clients on. That's why during the COVID crisis, we're bringing on tens of millions of dollars in new assets when everybody else is shut down. Even though we are working remotely, we're still doing that. Because people are looking at our value and they're saying, I want to work with those guys. They're going to provide me this, and this. So that point aside, it's just part of the webinar. I think it's very important that you understand. So what can you do in a scenario like this? This was the question that I asked myself before I even started this business, because I was working for my mom. I wanted her to be okay. Well, you got to focus on what matters. This all goes back to focusing on what matters to you. You got to drown out all the noise. There are a lot of people with different opinions. The only thing that really matters is what you want, knowing what you want. It goes back to what I was talking about at the beginning, knowing what you want and then doing what you need to do in order to get it. And there are specific tools that you can use to get what you want. And so all you have to do is ask yourself what matters to you, then determine what's in your control. And the next step is to find the products, services that will accomplish those goals, and then to find somebody who is intelligent and capable of providing you guidance with that. So this is a Venn diagram that took me about a decade to put together to make it this simple. But basically, you've got what matters, and this is why this is the focus of our relationship visit when we first meet with a client. What matters to you? So the gentleman at the very beginning of this webinar that said, I want to make sure that my income is sustainable. That matters to him. Why does it matter to you? I want to make sure I can take care of my wife for the rest of my life. Okay, that's what matters. What can we control? We can control the risk we take. We can control the fees that we pay. We can control how we set up our estate. We can control how we shield ourselves from long-term care. We can control how we take distributions from a tax perspective. We can't control inflation. We can't control cost of goods. We can't control geopolitical conflict. So there are things that people will lose the forest for the trees, okay? You got to focus on what you can control, and then just with extreme focus, find that convergence of what matters and what we can control, and then just hammer it out. And that's all you need to do. Advising doesn't need to be difficult, but the problem is we've got a sales industry and a lot of people that are motivated to sell you things that don't line up with what matters to you and what you can control. So that's why Crown Haven is doing this webinar, and that's why we provide the guidance that we provide to our clients, because we actually care about you. So let's revert back to the purpose of all of this. A lot of people have a lot of different opinions about investing. As far as I can tell, For 99% of Americans, the purpose of investing is income. If you can convince me otherwise, I will take off my hat to you and I will buy you a beer. But what is the purpose of investing if it is not to create money that we can use later to sustain ourselves? If you are not ultra high net worth, if you are not ultra rich, the goal is to save, to have that money grow for you so that when you're unable to work, you don't want to work. In the best case scenario, you just don't want to work. And you've got enough money to sustain yourself and your family. So the purpose of investing is income, to use it while you're here on earth. Otherwise, you're just saving a bunch of money to leave behind. And this, by the way, is a quick aside, but this gets to the whole tax thing. You know, at Crown Haven, we help folks that have, you know, taxable accounts that they don't want to sell because, you know, say they bought Coca-Cola at a really low price and now it's 10 times as what it was worth before, their cost basis. And they don't want to sell. What is the purpose of holding that if you're not going to use it? I'm not saying you sell it all at once. That would be crazy. You'd pay tons of taxes. But what is the purpose? So each part of your portfolio needs to make up an effective whole, but the purpose of all of this is for income. Of course you want to grow your money, with the end result being you want to use it. So then we go, okay, let's calculate the income gap. What is the income gap? This is very important for folks that are approaching retirement or in retirement. The income gap is very simple to calculate. It's your current income, and most advisors, by the way, are going to tell you, we'll get you 60% of what you're used to making, we'll get you whatever. That's BS. They're doing that because they're going to use something that's inherently volatile and unsafe, i.e. the market. Then they're going to charge you fees on top of it, so there's no way they're going to be able to get you to 100% of your current income, when in reality you can actually do that if you use the proper tool. But if you're interested about that, reach out to us at Crown Haven. We'll do a Retire Shield for you and we'll show you. But calculating the income gap, you take your current income, then you just take your anticipated Social Security, and they send you a notice out every 5 years, or you can go online and look at it, or if you come to Crown Haven for a Retire Shield, we'll calculate it for you. You take your anticipated pension, if you have one, if you're lucky enough to have one, and you subtract other sources of passive residual income. So maybe you own a rental property, or you've got royalties. I've got a client who has royalties from a product he invented. So current income, subtract anticipated Social Security, anticipated pension, other sources of passive residual income, you get your income gap. That's the difference between what you're making now and what you will be making in retirement, okay? So an example, somebody has a current income of $100,000. Their anticipated Social Security is $2,400 a month. That's $28,800 a year. Anticipated pension is $900 a month. It's $10,800 a year. They own a rental property, free and clear, $1,500 a month. That's $18,000 a year. They would have a $42,400 income gap. So most economists say that you need to fill at least 80% of your income. Most advisors try to get you to 60 to 70. Crown Haven tries to get you to 100%. But the point being, $42,000 income gap. So that's quite a bit of income that you're not going to have. And most people try to say, well, you know, Casey, I won't spend as much money in retirement, but that ignores inflation. It ignores a lot of other issues. So the goal is to get you to 100%. So now let's talk risks to income sustainability. And this was something that a few people at the very beginning of this, and just so you know, people that are typing in questions right now or comments, we'll get to those at the end. I don't want to be ignoring you. I'm not ignoring you. We're just going through what we've got here. But risks to income sustainability. So, and this is going to be some of the stuff that you're asking about. Let's examine some problems, okay? So market risk. Of course, one of the biggest risks to income sustainability is market risk. We just saw this happen on March 23rd. Now, a lot of people, if you're watching CNBC or paying attention to Jim Cramer, Mad Money, et cetera, they're looking at it as the market is split on whether or not it's going to be a V-shaped recovery or a W-shaped recovery or an L-shaped recovery. That's all well and good if you've got another 20, 30-year timeline and you don't need any money right now. If you need your money to create income for you over the next 5, 10, 15, 20, 25, 30 years, and you need it to do it sooner rather than later, you don't have time to come back. I saw a great quote, or it wasn't a great quote, it was a illuminating quote from a CNBC analyst that said the Standard & Poor was down 34%. It is now up 34% from when it was down, so we're back to even. No, we're not. If you have $100 and you lose 34% and then you come back up 34% from that loss, you're still down 12.5%. Okay? So that was like last week. Now we're down 9%. But the point is, losses, and this is what I just said, but a 10% loss needs a 20% gain to get back to even. Okay? Losses can delay retirement, and they compound issues. This is the big problem. They compound issues during the income phase. You've got money lost, you've got time lost, you've got a lower standard of living, maybe you're taking less money to live on, or if you take the same amount of money for income, your withdrawals are reducing your principal. Those are major issues. So when we look at, like I'm in my 30s, okay? I run a successful company, I've got savings myself. If I wanted to jump into the market right now, I could do that. Now my risk tolerance might be a little different than that, but my risk capacity, I've got capacity to take on risk. I've got 30 odd years of earning power left. I've got an emergency fund. My business is solvent. I could take risks. So I could pay attention to Jim Cramer and I could say, okay, I think it'll be a V-shaped recovery, and I put X amount of dollars back in the market. And if it doesn't work out, I still got 30 years of earning power, I still got X, Y, Z. But if you're 55, you do not have 30 years of earning power left. If you're 65, you do not have 30 years of earning power left. If you're retired, you cannot come back from that. So it's very important to notice what stage of the game you're in and what those risks are. And a lot of people tiptoe around this topic because it's fun. It is fun to pick stocks and do things like that. But and we get addicted to it. People get addicted to it. It's gambling. It's educated guessing. But for your entire portfolio, or even 50% of your portfolio when you need it to live on, would you gamble with the money you knew you needed to provide you dinner tonight? No. What you're doing is you're gambling with money you know you need to provide you dinner for the next 30 years. So it's important to put it in perspective. This was a chart we were showing to people before March 23rd happened. We were showing this to folks in January, and people were kind of chuckling at us. This is the Standard & Poor 500 from 1993 to 2020. Now, if you'll see, there's this period of time before the tech bubble, which is what caught my mom by surprise. It went up 238%, went down 47%. Then you've got the tech bubble to the Great Recession, up 95%, then down 56%. From the Great Recession to basically now, I can still say this, we're up about 394%. The Standard & Poor 500 lost 36%. So you can take 36% off that 394. Okay? So we're at what would that be? 364, 358. Okay? 358%. And then it gained a lot of it back. The point being, what do you think is going to happen? The people that are looking at this and going, it's a buying opportunity, scale. This all has to do with scale. We have never seen this type of unprecedented growth in the market in history. And this little dip that happened in March, I got news for you. On March 23rd, the stock market was still overvalued at 1.7% forward earnings. Prior to, and all that means is that if a stock should be worth $100, it was priced at 170. So that it was that much more expensive than it should have been. Prior, it was at 2.3 times. Right now, we're back up to about 2.1 times. So this is why, and real quickly, this is why a lot of people say, like Warren Buffett's whole investing paradigm, value investing, buying good companies at low prices, doesn't work anymore. Because there are no good companies at low prices. You can't get a good company at a low price right now. There's so much, because our company, Crown Haven, we do managed money too. There are no good companies at low prices. Everything is overpriced. And there's so much fake free money that has been pumped into equities. It's what goes up, what do you think is going to happen? And I guarantee you that your salesperson that you're working with that is operating under the guise as advisor, he has no idea what's going to happen. No clue. Just like I don't know whether or not it's going to be a V-shaped recovery or a W-shaped recovery or an L-shaped recovery. But I'll tell you this much. As a person in his mid-30s who has the risk capacity to lose, I don't have my money in the market right now. So the question becomes, would I put my mother or my clients in the market right now? No. No, we took gains in January. We got out. So, important. This is what experts have to say on the topic. Ray Dalio, founder of Bridgewater Associates, one of the most revered hedge fund managers in the world. I'd take 0 over a chance of losing money any day. Direct quote from Ray Dalio. Warren Buffett, I just mentioned him. Rule number 1 of investing, don't lose money. Rule number 2 of investing, don't forget the first rule. These folks understand the value of 0. They understand that it's okay not to gain. They just don't want to lose. If you have $100 and you lose 10%, you're down to 90. If you gain 10% on 90, you're not back up to even yet. And how much time does it take you to get back up to even? How does it feel to lose money you need? How did it feel to lose in the Great Recession? How many people lost money in the Great Recession? Just by comment. I don't need to know how much, but how many folks, we got about 278 people watching this right now. How many folks lost money in the recession? See all those thumbs up? 25, 30, 35, about 40 people have given me a thumbs up. They lost money in the recession. There's a lot of other people that probably don't want to say that. But how did it feel when you looked at your statement in March or in April and you're down even 10%? Because a lot of people didn't lose 30%, but they're down 10%. How does that feel? How would you feel if that never happened? A lot better, probably. Make no mistake, winter is coming. The fact is that all economies are cyclical. This goes back to the Roman ages. It's nothing but a credit cycle. The thing is, we don't know when winter will come or how harsh it will be. Some economists are saying that when this actually happens, it's going to make the Great Recession look like a Sunday afternoon picnic. We don't know what the results of this COVID thing are going to be on businesses. Right now, the reason the market is up, and I'm talking in May of 2020, right now the markets are up because they are looking at forward earnings. They're assuming that we're opened back up, and also they have thrown out all of their price targets for the second quarter because basically the world was in shambles. So right now, nobody knows what's going to happen. And economists are fearing a depression. Okay, it could be very likely, it is just as likely in January of 2021, I'm talking to you and we're in a depression, as it is that we're back to normal. It's like a 50-50 split right now. So, who knows? Some important thoughts. Do you believe the world is in a better place right now than in December 2019? No. How long did it take to get back to even the last time the market crashed? And do you have enough time to do that? Can you afford a loss while using your money for income? And the market doesn't have to get it right every time, but you do. In the Great Recession, folks lost their homes. They lost everything. I watched it happen to my family. And the bankers didn't go to jail. The bankers were actually playing both sides of the game because they have enough money to short. And they made billions of dollars. Bill Ackman, who's one of the largest hedge fund managers in the country, made over $1 billion in March of this year, shorting the economy. This year, when people are dying, Ackman made $1 billion. The market doesn't have to get it right every time, you do. If you're a nest egg, if what you're relying on is in a 401k, IRA, variable annuity, anything market driven, if you've got a quote unquote advisor managing it, charging you a fee, in mutual funds, ETFs, you're not safe. And you have to get this right. You've only got one chance. So I think what we're going to do is we're going to take a quick break, and I'm going to come back and I'm going to talk numbers. So we're going to take a 5-minute break. We're going to let people write down some questions, type questions, and I'm going to get into the numbers section of this presentation. Okay, thank you.
Marker.
Welcome back, everyone. This is Casey Marks, founder, president of Crown Haven Wealth Advisors here in Carmel, Indiana. This is going to be part 2 of our Retire Shield webinar. I want to thank you for watching. We just took a quick 5-minute break so I could grab some water, and anybody wanted to make themselves a sandwich, use the restroom, do anything that they wanted to do there. We're going to get into the numbers and the figures of some of these things that we've been talking about in relation to income planning, risk management, legacy protection, tax planning, etc. Before we do that, though, we're doing this live. There are a lot of folks that have been commenting, asking questions. So I brought 2 of my team members from our social media department in here. We're simulcasting across several different social media networks right now. And so we've got some questions. So I'm going to let James go ahead and ask a question from the audience.
Yeah, we got Brian here from Indianapolis. He's saying, I've saved for years and I was in great shape overall, but in these uncertain times, seeing some of my friends get sick, this virus really has me worried. I want to make sure that I'm set up correctly for my family, so when I'm gone, they're taken care of. What advice could you share? Well,
first of all, Brian, I want to thank you for the question and thanks for watching today. I would first of all say, I hope you are healthy and your family is healthy and everyone that you care about is okay. This has been a turbulent time for everyone. It's been something that has really rocked us to our core. There's a lot of different news coming out, both from our national news publications as well as economic news that's coming out. So it's been a really jarring time. You add on top of that the economy basically grinding to a halt. That is something that has been scary for a lot of people. So what it's done, and what I've said when I've gone on network television, I've been asked to do interviews for Fox and Wish TV and et cetera, et cetera. What I've said when this question has been posed to me is some version of this, in a way, could serve as a wake-up call for a lot of folks when it comes to income planning, when it comes to risk management, and particularly the question that you're asking, Brian, which is legacy planning. And how do I want my funds to be dispersed if something should happen to me? Things don't become real until they become real a lot of times, and we don't know what we don't know until it happens. So a lot of people I've been sensing with our current client base, and then folks that are reaching out to me on my radio show, or folks that will interact with us on social media after I speak on TV or whatever it may be, are really feeling their mortality right now. And they're saying, and look, I'm a perfect example. My dad died when he was 54 years old, and it was completely out of the blue. We did not anticipate it. My mother and I had to figure it out, and that's why I got into this industry, because my mother was basically taken advantage of by an advisor who really didn't do what was in her best interest. So I empathize with how you're feeling right now. The first thing, so there's two ways that you can protect your assets for the people that you care about. You can go the legal route, or you can go the insurance route. So the legal route involves wills and trusts and power of attorneys and all of that stuff, which we help our clients with at Crown Haven. We work as liaison for several trust attorneys and family law attorneys and things of that nature, estate planning attorneys. The other route is the insurance route, where you can literally insure the money. Some folks will buy life insurance to offset tax implications, or they will literally put their money in insured vehicles so that probate won't be an issue, for example. So what we do at Crown Haven is we like to ensure that no entities can really get through the shield that we've put up for our clients. And we use a mixture of the legal route and the insurance route to ensure that no matter what happens, the funds are dispersed accordingly. And this is a very personal thing. I'll use one of my clients as an example. I've got a client who has a huge family, has 4 children, and some of the moms out there that are watching might laugh at this, but his children are, they've all gone through college, and a couple of them are married. So he's got 2 sons that are married, and one son is the guy that, he told me a story that they went on a vacation to Aspen, Colorado, and he said, Dad, come outside, I got to show you something. And the dad thought he was going to show him like a bear or something, and it was this Lamborghini that was in the driveway. So one son is the guy that when Dad dies, he's going to spend the money on a Lamborghini, or he thinks so. The other son is married to a woman that he very much loves and appreciates, but he's always kind of been the pushover in the family, and so they're worried about what would happen if they left the money there. I mean, it's a very delicate situation, but they've told me that. Their other son is the type of person that's going to take care of everybody. So he's just the guy that cares about everyone and would give the shirt off of his back. So there's a very specific way that they want their funds to be distributed to their different sons. And that can only be accomplished, well, first you've got to protect it. So you've got to use products and services that shield creditors and shield it from the probate process. But then it can only be accomplished through advanced planning to have funds distributed the way you want them to be distributed. And just designating a beneficiary on a 401k plan is not going to do it. So what I would say to Brian is there's a mixture that's involved. That's why it's number 4 in our, or number 5 in our Retire Shield process, which is advanced legacy planning. Because this is something that everybody cares about, and particularly with this COVID epidemic, this pandemic that's occurred, people are really feeling their mortality. So Brian, I would encourage you, if you've got an estate planning attorney that you're working with, I would encourage you to update your trusts. Something else that, just real quickly, there was an act that was passed January 1st of 2020 called the Secure Act that changed some of the rules regarding how trusts are interpreted. So that would be something to do anyway. But there's always a mixture of an insurance and legal path to ensure that you are shielded, and that's why we do it for our clients that way. Hopefully that was a good enough answer. It's long-winded, and my social media team's looking at me going, okay, that's enough, Casey. All right, do we have another, you got something?
Yeah, it looks like this one's from Rick, who I think might be a current client.
Rick, cool.
Yeah, Rick wanted to just say that Crown Haven is awesome. We just locked in a $100,000 gain in the last few weeks.
Yep.
We were with one of the big guys for many, many years, but we never really knew what we were missing until we met Casey. Listen to him with a couple exclamation points.
That's cool. Rick is a great client. We've been working with him for about 3 years. This is more advanced planning, but because of where the 10-year Treasury yield is right now, we were able to basically, there's just some advanced planning that we were able to do, lock in a $100,000 gain for him, so that was pretty cool. We actually did that with a number of our clients, about 60 of our clients out of the 700 families that we service, so that was pretty neat. Braden, do you have something for me?
Yep, so Steve from Noblesville says, I was comfortable paying fees with my performance prior to the virus, but with what happened in March, I've become worried. With everything going on in the current markets, what are you recommending for your clients?
Well, thanks for the question, first of all, Steve. That's a difficult thing to give broad-based advice to everyone, because like I say, every single person's situation is different. What I would say to Steve is don't panic. I said this in the last segment that we did. Economists are split, market makers are split of whether or not this thing is going to be a V-shaped recovery, which it goes down, then jumps back up real quick, or if it's a W-shaped recovery, which it goes down, it jumps up, then it goes down again, kind of like a bear rally. So, long story short, this is going to be turbulent for a while. In the case of paying fees for subpar management, look, Morgan Stanley came out at the end of last year and they said that the traditional portfolio of 60% equities, 40% bonds is not going to work anymore. And it gets back to what I was talking about in the last segment with regard to companies are so overvalued, there is no more value investing. You can't get a good company at a low stock price. If you combine that with the fact that bonds are at all-time lows in terms of the yield that they will give, if you had 60% of your money in equities and 40% of your money in bonds, your return, your average return, Morgan Stanley says, is going to be about, it's like 2.7% over the next decade is what they're saying. So to Steve, who's asking, or saying I was comfortable paying fees until COVID, what I would say to Steve is over the past 10 years, we've been in an unprecedented bull market rally. The market has been basically, you could throw a dart at the board and, the market would be growing. Your money would be growing, rather. But now, bonds are at an all-time low. Equities are overvalued. There's tumult in the marketplace. We don't know what's going to happen with the coronavirus. What I would say to Steve is if you want to just ride the market, stop paying a fee to somebody to manage your money for you to put you in the same mutual funds you could buy yourself, number one. You don't pay an advisor so they just put you in mutual funds. Like that's, I'm not trying to be rude, but that's not very smart. That's what a lot of people do because they don't know any better or they've been taught that. But all a mutual fund is they've done the work for the advisor already. So now you're paying mutual fund expense ratios and you're paying the advisor fee. And fees kill you. So if you wanted to do what your advisor's currently doing, you could literally replicate that by going onto any number of online platforms and purchasing lower cost exchange traded funds or mutual funds and track the same things that you're currently tracking, but save yourself 1% or 2%. The reason you pay for an advisor is so they can help you with all this other stuff: income planning, risk management, tax planning, legacy planning, long-term healthcare planning, to ensure that you've got a plan, right? Not just so they can put you in mutual funds and charge you a fee. So that would be my statement there. What I also will say is that if you've lost, a large portion of your money over the course of the last month and a half, as painful as it might be, you don't want to panic sell. You need to determine your own risk capacity. Can you afford to lose another 20%? That's a personal thing. That's not tolerance, that's capacity. Can you afford it? Would it be better to not be in that situation and in a position where you can only grow? Do you know about things that do that yet? I mean, if you don't, reach out to us. We'll talk to you about it. But there's really no broad-based advice I can say, like just sell or buy, but there are advisors out there that can walk you through this, that can provide custom-tailored advice to help eliminate some of the problems you're facing. And I would obviously encourage you to reach out to us because we can help you a great deal. Do we have anything else? Right now we're good? Okay. All right, so I'm going to get into the numbers of this. So first segment was really just talking about identifying what we want out of retirement, why we want it, talking about the system in general, the financial system, why it's an issue. The purpose of investing is income, those threats that exist to that purpose of investing. So now we're going to start talking about some of those threats to income. And the first one I'm going to talk about is sequence of returns risk. So sequence of returns risk is the order or chance in which you experience losses or gains in your retirement account. And that chance, that game of chance, directly impacts how long your money is going to last in retirement. So all this is saying is the order in which you experience losses or gains determines how long your money lasts. So I'm going to illustrate this with some charts here. But the main point of this is going to be to show you that, in my humble opinion, and this is something that we've done for our clients across the country and over 700 families in the state of Indiana, if I had a choice between having my money in something that was inherently volatile and unsafe to provide me income and pay a fee for that, or something that was secure that could do the same thing, I would choose something secure 100% of the time. Okay, so let's look at a slide here. So this is what we call a bad sequence of returns. So let's set the table. Here's Alan, and Alan retired in the year 2001. Now Alan, we're showing his returns from 2001 for 15 years, okay? Now, Alan retired with $1 million, so he thinks he's safe. I mean, that's the goal. He got to $1 million in savings. Now, when Alan retired, he was making $120,000 per year. So if we go back to our income gap calculations that we were doing, Alan wants to get as close to filling that gap as possible. So he and his advisor determined that a $65,000 withdrawal from his account, combined with Social Security and his small pension that he had, would get him close to about $100,000. So it's not quite $120,000, but it's going to keep him pretty comfortable. So he wants to maintain a standard of living. He understood that he couldn't get 100% of $120,000, but he could get close. He could get $100,000. And they felt comfortable utilizing 6.5% of his money, 65 grand, of that $1 million to do that because they believed in the market. Now, as you can see, as soon as Alan retired, 2001, 2002, 2003, terrible returns. When he's 65, he loses 9.3%, 9.03%, excuse me. 66, he loses 11.85%. And 67, he loses 21.97%. And coincidentally, this is what happened to my mother, and this is why I got interested in this business. So, for those keeping score at home, Alan has taken $195,000 of his own money out. So if everything remained the same, if Alan just had his money in a hole in the ground in the backyard, he would have $805,000. He had $1 million, he took out $195,000, he should have $805,000. But he had bad returns the first 3 years. So if you look at the end of year 3, he has $465,000. So he's gone from $1 million to $465,000 in 3 years. Now, I'm going to point out year number 4 because this is what always gets told to investors. Okay, the market went down, but it's going to come back. Well, it did come back. It came back in year 4. He had a 28.36% return, which brought his $465,000 to $532,000. So even with a 28.36% return, which is huge, by the way, his 465 only grew back to 532. Why? Because Alan is taking $65,000 out to live. In fact, Alan gets 5 more years of positive returns, 28%, 10%, 4%, 15%, 5%. And he's basically treading water. He's at $457,000 at age 72. Just in time for the recession. When the recession drops him by 36%. And this is really the death knell, because now Alan's got $225,000. And now he's got a choice to make. Do I take the $65,000 and reduce my principal, or do I reduce what I'm taking out of my money and reduce my standard of living? Alan, with his advisor, believed that the markets will come back because he's dealing with a salesperson, remember, and the salesperson wants to still charge him a fee. Hey, I'm just going to keep it here. And the result of that is after 15 years, Alan has negative $19,000. That's a bad sequence. Now, the question I would ask, actually before that, this example is not taking into consideration fees, number one, which would further reduce it, or inflation. Inflation would degrade his purchasing power on that $65,000. Now, the question that I would ask is, do you think anybody watching this right now, and I want a show of thumbs because I can't get a show of hands because this is a webinar, do you think had Alan known of a positive alternative, do you think he would have taken that at age 65 knowing what the outcome would be? And let's see how many positive thumbs we get here. There should be quite a few. I got like 32 positive thumbs. We got 43 positive thumbs. I got almost 60 positive thumbs as of right now. So roughly a quarter of the audience is in agreement with me right now. That's cool. All right, so we'll show you another scenario. So now we're going to look at Bob, okay? So here's Bob. The only difference between Alan and Bob is the sequence of his returns are flipped from Alan's. So if you notice what I did to the returns here, now this is not what happened in real life. This is not an actual result, but it's just for illustrative purposes. Alan's returns are on the bottom, the negative 9.03, the negative 11.85, the negative 21.97. All we've done is we've flipped the returns. So now all the positive returns are at the beginning for Bob, and all of his negative returns are at the end. The recession still happens around the same time in the middle, okay? Now Bob's got the exact same situation. He's got $1 million beginning balance, $65,000 withdrawals, and because Bob doesn't take losses at the beginning, basically at the end of the day, he's still got $877,000. That, my friends, is sequence of returns risk. So while Bob just happened to be lucky, he didn't have bad returns right when he retired, and Alan did have bad returns right when he retired, That's the disparity between how their retirements ended up. Okay? That's why you can talk to one person and they can say, this broker-dealer is awesome. I've been working with them for 30 years. I love them. And somebody else can say, this broker-dealer is the worst broker-dealer in the world. It's not the broker-dealer, it's the market. Okay? So the question becomes, do we want to leave this to chance? And I'm going to ask that of all you watching right now. Do you want to leave this to chance? I've got a bunch of no's here. How are we looking on social, guys? Do we have...
We got about 15 more no's on Facebook, a couple more on Twitter. Yeah.
So people are saying, yeah, they do not want to take a chance with this. Okay. So I'm going to show you what Crown Haven does for their clients. So here's Alan with a bad sequence, and then if Alan would have been a client of Crown Haven. So I want you to pay attention to the first 3 years. Alan's bad sequence, negative 9%, negative 11%, negative 21%. With Crown Haven, we would have put a floor underneath his principal, so he could not lose. We would have insured it. Okay, and this is what we do for all of our clients for the amount of money they need to have secure. We would have insured it. So, taking his $65,000 withdrawals, if you notice, after 3 years, he's got $805,000 with us, where he was, he had $465,000. Now, the trade-off for that is in year 4, when he receives a 28% return in where he was before, he would only receive a 21.27% return with Crown Haven. So in other words, there's a ceiling to his growth potential. But does that matter, is the question. Does it matter? So the question really becomes, of these two scenarios, do you want to have all the losses and all the gains? Or do you want to have none of the losses and most of the gains? Well, math will prove to you that it's better to have none of the losses and most of the gains, because in Alan's scenario, a bad scenario, after 15 years taking the same $65,000, Alan has $1,175,000, and he's been taking $65,000 a year for 15 years. Whereas if Alan wanted all of the losses and all of the gains, negative $19,000. So this is the fallacy that is repeated over and over to clients of traditional advisory firms. Why would you ever want to put your money in something that limits your upside when you could have unlimited growth? Well, when you have unlimited growth, you also have unlimited downside. And by the way, the advisor you're working with doesn't have all of your money in one pot. So if Apple goes up 100%, you're not going up 100%, you're diversified. So you're not getting 100% of the upside anyway. So the key, and this goes back to Ray Dalio and Warren Buffett in our first section, the power of zero. The power of zero that's occurring here with Crown Haven, not going backwards, even if you only get 75% of the upside and no downside, you've got $1.1 million at the end versus negative $19,000. So some of you might be thinking, okay, Casey, that's a bad sequence. Let's look at the good sequence. Okay, let's look at Bob. Now Bob, remember, he had a really good sequence. He didn't lose until the end. This I want to talk about because now for the first 7 years or so, Bob's buddies with Crown Haven, they're telling him, Bob, are you nuts? The market went up 13.48%. With Crown Haven, you're only getting 10.11%. The market went up 31%. You're only getting 23% with Crown Haven. The market went up 15.89%. You're only getting 11.92% with Crown Haven. The market went up 2.1%. You're only getting 1.5% with Crown Haven, et cetera, et cetera. His golfing buddies are ragging on him, and they're only talking about their wins on the golf course, telling him, why would you be giving up the upside, Bob? The reason Bob gave up the upside is because about 7 years in, the recession hits, and Bob has the power of 0. So now Bob doesn't lose. So if you look at age 71, Bob's been taking $65,000 out for 7 years. He's got 1.173 on one side. On the other side with Crown Haven, he's got 1.4. And then if you take it to its finish, Bob would have either 1.6 million with Crown Haven, or he'd have $877,000 just playing the scenario out. So again, even in a really good sequence, it's better not to go backwards. By the way, again, just for a reminder, on the side that has the downside, we're not showing you fees. We're about to show you fees. But how many people, and I'm going to ask this of the social too, guys, how many people think the power of 0 is more powerful than where they're currently sitting? And who wants to learn more about that? And I've got, well, I'm lighting up right now. I've got at least 40 thumbs up. That just doubled. I'm at like 80 right now. James, what do you got on Facebook?
Got about 24, now 27, counting.
Just going up. Braden, how you looking?
Similar numbers. Started early and we're kind of doubling as we're having this conversation right now.
Yeah. So the people that are watching right now live are, and they've got the link to the Retire Shield, right? Mm-hmm. Okay, good. Click the link on crownhaven.com for your custom tailored Retire Shield. We'll take you through this process and show you exactly what we do for our clients. But this is just one aspect of it. But the power of 0 is so powerful. Our clients didn't lose a dime in March. In fact, Rick, who was talking earlier, we locked in a $100,000 gain for him. So, but this is sequence of returns risk, and this is why it's important. Okay? The next thing that is an issue for income sustainability is fees. So I want you to remember this. For every 1% you pay in fees, you are giving up 10 years of retirement income. Okay? For every 1% you pay in fees, you are giving up 10 years of retirement income. All right? So we're going to play a video here. And you're going to watch my mouse move around. So with no management fee, this is the Standard & Poor 500 from 1999 to 2019. If you had $1 million in 1999, in 2019, you would have $2.6 million. Your average rate of return would be 6.26% with all of the up, all of the downs, okay? Now let's add a 0.5% fee. It just went to 2.3 million. So you lost $300,000. Your average return is 5.76. Let's put it at 1%. 2.1 million. Almost $500,000 lost to a 1% fee. Your return went down to 5.26. Now let's put it at 1.5. 1.9. You started at 2.6, remember. Now you're at 1.9. Your returns just keep going down. Let's put it at 2. 1.7 million. The returns are not changing. It's the fees that are going up. So now 2% fee. Let's go 2.5% fee. $1.5 million. 1 million to 1.5. 3.76% return. That's a difference of $1.1 million. If we go back to 0, $2.6 million is what you should have. 2.5% fee, $1.5 million. I guarantee you that every single person watching this right now, if you are working with an advisor, you are paying between 1% and 2.5%. I guarantee you. So the question becomes, do you love your advisor, knowing what I just showed you about sequence of return risk, by the way? You don't have the power of 0. You're going to go backwards. Do you love your advisor enough, on top of that, to give up $300,000 or $500,000 or $800,000 or $1 million of growth over the next 20 years? Why would you do that? If you knew of an alternative, would you take that alternative? I would. So this is what we show people during our Retire Shield consultation. We do a relationship visit, we get to know you, then we do a diagnostic report where we show you exactly what fees you're paying. We show you the risk you're taking, the fees you're paying, how it will work from an income standpoint, from third-party tools that we use, Nobel-winning tools that we use. Rocket scientists built the tools that we use. So this is fees, and for those of you that were following that chart and it was a little bit difficult, this is the breakdown. So a 0.5% fee is $255,000 over a 20-year period on $1 million. That's 5 years of income, assuming you want $50,000 a year. A 1% fee is $487,000 over that 20-year period, or 10 years of income, assuming you want $50,000 a year. A 1.5% fee is $697,000, or 14 years of income, and that's over that 20-year period, assuming you want $50,000. A 2% fee is $887,000, or 18 years of income. 2.5% fee is $1,060,000, 21 years of income. So when I say for every 1%, you're giving away 10 years of retirement income, that's why. And by the way, that period of time, 1999 to 2019, pretty good test subject. You had a dot-com bubble, you had a recession, and you had the longest bull market in history. So it was going up, it was going down. That's a great example of both ways, up and down. And guess what? The fees just eroded your growth. They eroded your growing power. They ruined the miracle of compound interest, depending on how much you were paying. Here's another risk to income sustainability, longevity risk. So if you and your spouse make it to age 65, then you have a 33% chance that both of you will live to your 90s. That means your money has to last, especially with Social Security's uncertainty and pensions being a thing of the past. So from the very beginning of this, we talked about our what and our why. So if you want that what and why to become a reality, your money has to last, and for it to last, it has to be protected against losses. This is where proper asset allocation plays a huge role. Now, as we move towards retirement, it's crucial that we reallocate our funds, and this is why we do it at Crown Haven this way. We reallocate our funds into a more secure income source, building an income floor to cover all necessary expenses. Now, this is just a fun thing to go through. So let's see what people have to say about this on social. So here is a series of numbers, and I want you guys to tell me what you think these numbers mean. We got a 2, a 3, a 7, a 10, a 52, and a 20. Now, maybe, do we have any guesses yet? No? All right. Maybe it'll help if all right. So it equals $436,000. Somebody said days. Okay, so that's close, okay? So 2 people, 3 meals, 7 days, $10 per meal, which is a really cheap meal, 52 weeks in a year, 20 years to live. This is assuming you're only giving yourself a 20-year timeline to live. You got a spouse. You want to eat every day that you live. It's $436,000. That's just meals. Hopefully this point drives home why it's important to have secure income sources, and no, Social Security is not enough. So a good way to look at this, and this is something that a lot of advisors talk about, is the maximum percentage rule. So you take 100 and you subtract your age from that, and that should be the maximum percentage you are allocated towards equities. So example, Doug is 65 years old. The maximum amount he should be invested in the market is 35%. The other 65% traditionally was put in bonds. The problem now is that bonds yield nothing, so what does Doug do? Most people, most advisors just say keep them in equities because those are the only things that are growing. And we can charge them a fee because we keep them in equities. Well, first of all, this rule it's not correct for everybody. We need to get a lot more specific with each of our clients. And at Crown Haven, through our proprietary Retire Shield process, we determine this exact percentage because we want to ensure that no matter what happens, you have enough money secure to take care of you. It's just like building a house. Anything needs to have a strong foundation. So what we look at is we look at what we call our 3 buckets. So, and this might be helpful for you to think about in terms of your own money right now. The first bucket, 0 to 1% return. It's an emergency fund. It's insured. It's liquid. There are no fees for it. It's just there. It's there to help you in case you need money for emergencies. The third bucket is 8% plus or minus. It's not insured. There's management fees. It's liquid to the extent that you want to sell it. I mean, if you're down, you don't necessarily want to sell. There's growth potential, but it serves as unreliable income generation because it's going like this, up and down. The second bucket, 5 to 8% return, it's insured, there's no fees, it's liquid in emergencies, it gives you growth potential, and it gives you reliable income. 99% of the folks that come into Crown Haven to talk to us initially have 90% of their money in bucket number 3, maybe 5 to 10% in bucket number 1. Nothing in bucket number 2, because they don't know bucket number 2 exists. Nobody showed them bucket number 2. Do you want to know why? Because you don't make a lot of money selling bucket number 2. You make a lot more money selling bucket number 3. If I had $100 million under management and I charged 1% on that $100 million, that's $1 million of revenue for my firm every year, no matter whether or not you win, lose, or draw, right? If I put that same $100 million, you know, and I assume that you're my client for 20 years, that's $20 million. If I put that same $100 million in bucket number 2, instead of $20 million over that 20-year period, I make more like $6 million. So I cut my revenue by over 50% using bucket number 2. So that's why you don't hear about bucket number 2. It's not a moneymaker. But at Crown Haven, what we do, because we're a fiduciary firm, we're independent, we can use everything, and we look at it holistically, is we want to make sure that you have enough in bucket number 2 so you're secure forever. Then you have enough in bucket number 1 so you can handle any emergency that comes your way. After both of those 2 things are taken care of, then we look at bucket number 3. It's practical. It's the practical way of approaching it. And our clients love it. And you've never been shown it. Here's an example of a client that we worked with. It was Matt and Lisa Smith. Now we've changed their last name because for obvious reasons, but they had a $250,000 beginning balance. Matt had a 401k at Vanguard for $80,000. Lisa had a 401k at Vanguard, $80,000. Matt had a brokerage account at T. Rowe Price for $42,500. Lisa had a brokerage account at T. Rowe Price for about the same amount. They had joint checking and savings for $5,000. So you get what I mean. Most of their money was in bucket number 3, and they had $5,000 in Chase. Their risk score was 63. So this is a program that we use that tells us a risk score from 1 to 100. So 1, you buried your money in the backyard and you've got armed guards. And 100, you've got your money on a roulette wheel. So 63 is pretty high risk. It also gives us a 95% probability of what's going to happen over the next 6 months. So basically, if you look at the percentages there, they're on a teeter-totter. They can either lose, I think it says 13.21%, or gain 18%. So it's up, down, up, down, up, down. Their potential annual return with this portfolio is just above 4.5%. They're paying almost 50 basis points in expense ratios, and their advisory fee is above 1.5%. So for that 4.8%, they're also paying fees to achieve it. If we go to the next page, if a bear market were to happen again, on the right-hand side, that is their portfolio. They would lose $66,000 out of $250,000. If the financial crisis were to happen again, with their exact positions, they would lose $95,000. So what I asked Matt and Lisa was, is it worth it to you guys to lose $95,000 to get a 4.9% return, 4.8% return? Is it worth it to have the possibility of losing $95,000? Of course not. They'd rather put their money in a CD and get 1.5% with no chance of losing $95,000. But here's what we did for them. Oh, by the way, before we go to what we did for them, our entire goal is we're trying to create income. So we want them to have a 95% probability or above, statistically significant probability of an income amount working. So what we did was we took the $250,000. They were planning on retiring in 2024, and what I have circled here is the amount of monthly income, $590, the maximum amount of income they could have taken from Vanguard and T. Rowe Price before their income broke, before it went below 95% probability and it turned red. Okay? So that was the maximum amount of income they could have taken with how they were positioned. So I basically told them, I said, hey, you got this income gap. You're used to making $100,000 a year. We know Social Security is not going to cut the mustard. It'll get you $40,000 a year. So you got a $60,000 income gap. With where you're currently positioned, you can get about $7,200. How's that sound? They said, I don't like that, Casey. I said, I don't like it either. So here's what we did. We repositioned $210,000 of their $250,000 into bucket number 2. Now, bucket number 2 averages over 8% annually. Their other $30,000 we put in bucket number 3. Bucket number 3 averages over 11% annually. Bucket number 3 still has risk, though. Bucket number 2 doesn't have any risk. By doing that, their potential annual return went from 4.8 to over 7.5%. Their risk score went from 60 plus to 4. And if you look at their 95% probability, they've got very little probability of losing any money. If you look at their advisory fees and their expense ratios, those went down almost to nothing because we're only charging a fee on the amount of money that's in the strategic growth, the $30,000. So even if we charged a 1% fee, it's only 1% on $30,000, where before they were being charged 1.5% on $250,000. As a result of that, in a bear market, Matt and Lisa would only lose $67, and in a financial crisis, they would only lose $4,000. So we've saved them $91,000 in potential losses by repositioning them. On top of that, from an income perspective, we've increased their monthly income from $590 to $1,150. We've doubled their income, and it's got a 95% probability of working. So for those keeping score, we have reduced their fees by 90%. We have increased their income by 100%. And we have taken their projected losses from $95,000 to $4,000. Just by a couple simple reallocations. That's what Crown Haven does. That's what a Retire Shield will do for you. That's what working with an independent fiduciary holistic advisor will do. Here's the comparative chart. Before they had a risk score of 63. With Crown Haven, they got a risk score of 4. Before they had a potential annual return of 4.8. With Crown Haven, they got a potential annual return of 7.63. In a financial crisis, their possible loss was $101,000. With us, it was $3,970. Their annual advisory fees went from 1.96 to 0.11. Their expense ratio went from 0.31 to 0.02. Their total annual cost went from $4,802 to $264. Their total cost over their lifetime went from $158,000 to $8,712. This is why our business has been doubling every year since we were founded. It is our job to do what is in your best interests. We will naturally grow by doing that. And that is the bet that I made when I started this practice. So, if we look at the 3 buckets, the question becomes, where do you want your money? Do you want to remain in bucket number 3? Paying a fee to somebody who's going to get you subpar performance, knowing what fees do to erode your miracle of compounding growth? Do you want to remain in bucket number 3 with those fees, knowing that sequence of returns risk is very real? Do we think that the market's going to go up or down in the future? Do we know? Do we want to bet our future on that gut feeling? Do we want to play that game of chance? Are we positioned in a way that ensures our children will be taken care of or our spouse will be taken care of? Are we positioned in a way that's going to take care of the income gap that we know we will have when we retire? It's fun to try to pick stocks. We do that at our firm, but we don't do that until bucket number 2 and bucket number 1 are taken care of. That's the difference. And we don't charge you a fee to pick stocks for you on money that you shouldn't have in the stock market to begin with. Here's our process. It's called the Retire Shield. We believe in buying our clients and our prospective clients a cup of coffee. So what I'm going to do is every single person that's watching this right now, I'm going to offer you the ability to go through our entire Retire Shield process for free and with no obligation. We want to earn your business. I'm personally obsessed with my client's positive outcome. And I am certain, and my team is certain, that if we are given the opportunity, we will show you how to reduce the risk you are taking, reduce the fees you are paying, minimize your taxes on investments, secure an income plan that protects you for life, protect you against the rising costs of long-term health care, and ensure that your legacy is intact and distributed to the people you care about most. We go through 5 stages: secure income planning, cohesive investment strategy, advanced tax planning, long-term healthcare planning, and proactive legacy and estate planning. If you go through this entire process with us, we will deliver to you, after establishing a relationship built on trust and shared values, discovering your unique goals, needs, and desires, and reviewing your portfolio, we will deliver to you a diagnostic report, a review of your current plan and discoveries made. We will conduct a crash simulation on your portfolio. We will discuss a retirement income readiness report. We will reveal an in-depth fee analysis. We will produce an entire Retire Shield for you. It will have a secure household income plan. It will have a personalized investment allocation. It will have a tax-efficient withdrawal strategy. It will have reinforced long-term health care recommendations. It will show you how to proactively avoid probate for Brian out in Indianapolis, who was concerned with that. Personalized investment allocation for Steve in Noblesville. And if you choose that you want to engage us, then we implement it. If you choose that you don't want to engage us, we will part as friends, and you will be more educated than you have ever been working with a firm. Because I understand that as a business owner, as the small hardware store across the street from the Home Depot, we have to provide exceptional value to our client base. And that is what has grown Crown Haven from something I imagined to a firm that is now responsible for hundreds and hundreds of millions of dollars and is consistently outperforming its peers. If you become a client, we will offer persistent monitoring and portfolio optimization. This includes regular meetings, portfolio monitoring and reallocation, he's going to come back. It's all right, give it a second. If you become a client, we will offer persistent monitoring and portfolio optimization. That means regular meetings, portfolio monitoring and reallocation, comprehensive benefits review on an annual basis. That means health insurance, life insurance, employer benefits, government benefits. Complete and proactive annual tax strategies. We do not prepare your taxes. We look for opportunities to reduce them legally and ethically. We help with Medicare planning. We help with trust and will reviews. We offer services basically to be the quarterback of your financial life. Our mission at Crown Haven is to ensure that our clients spend less time worrying about their money and more time enjoying their lives. The entire reason that you're watching this is because you want it to reflect back positively on your life. That is why we are here. Our vision is to be the last advisor our clients ever need. This is our team. We are local, we are independent, we are fiduciary. I want to thank everybody for tuning in today to this webinar, and for those of you that aren't watching it live, there will be links that you can select if you would like a copy of my book, Baby Boomer Retirement Boot Camp. If you would like our Mark's Market Update, which is a weekly market update that we provide free of charge. If you would like to listen to my podcast, Mark's Money, there's a link for that. If you would like your custom Retire Shield, come on in for a relationship visit, or we can do that virtually. We're offering virtual appointments. There are several ways we're trying to bring you guys value. And we want to be viewed as another pillar of this community, and that is what we are establishing ourselves as. James, do we have any other questions, or Braden, do we have any other questions right now from anybody that's been watching?
A lot of thumbs up.
A lot of thumbs ups?
Smiley faces.
Anything? Okay. All right, well, we're going to end that here then. I want to thank you. This probably isn't going to be the last one of these that we do. It's been a couple hours of content, so hopefully it's been enjoyable. But if anybody has any questions, you can reach out to us directly via our website, and we will be in touch with you. Thank you very much.